Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everyone. This is the Northbound Wealth Podcast, our 116th episode. Let's dive into the weekly market insights. Investors react to mixed signals. Stocks rose last week despite mixed signals on inflation, as investors kept one eye on the Fed's September meeting. The S&P 500 index rose 0.9% this week, scaling new peaks in 4 consecutive trading sessions as the probability of an interest rate cut in September remained elevated following divergent inflation reports. The Nasdaq closed out last week at 21,692.88, which was up about 12.87% year to date. The Dow is up 6.1% on the year, while the MSCI EAFE index, which tracks overseas developed stock markets, is up about 22.99% on the year. The S&P 500 ended Friday's session at 6,449.80, bringing quarter-to-date gains to 4% and year-to-date growth to 10.84%. Following a weaker-than-expected non-farm payrolls report last Friday and a surprise drop in the Institute for Supply Management U.S. Services Index, or the ISM survey, the U.S. seasonally adjusted consumer price index rose 0.2% in July, as expected in a survey compiled by Bloomberg, and below the 0.3% gain in June, according to the Bureau of Labor Statistics, or BLM, on Tuesday. The odds of a 25 basis point cut in September reached 99.9%, almost 100, right? After the soft consumer price data. According to the CME FedWatch tool, this near certain probability, however, dissipated to 92% on Thursday after BLS data showed the producer price index rose 0.9% in July from no growth in June, and compared with the 0.2% increase forecast in a survey compiled by Bloomberg. The rate cut probability settled in at 89%. Late on Friday, after the University of Michigan's preliminary consumer sentiment index fell 58.6% in August from 61.7 in July, below expectations for an increase to 62 in a Bloomberg compiled survey. Respondents' one-year inflation forecasts at 4.9% were up from 4.5% in July, while 5-year inflation outlook climbed to 3.9% from 3.4%. Healthcare, communication services, and consumer discretionary were the top 3 gainers this week. Eli Lilly is among several Western pharmaceutical companies that have applied for their drugs and treatments to be included in China's new catalog of commercial health insurance, according to a Bloomberg report. Separately, Eli Lilly announced that its obesity and type 2 diabetes drug Mounjaro, in its quick pen form, is now available across India in all doses. The company also plans to increase the price of Mounjaro in the UK, stating in September to align pricing with other developed countries. Shares of Eli Lilly jumped 12% this week. Meanwhile, Paramount Skydance announced it will develop its Nickelodeon, MTV, and BET networks, as well as boost feature film production, according to multimedia reports. The announcement comes a week after the $8.4 billion merger of Paramount Global and Skydance Media. Shares of Paramount Skydance surged 31% this week. The consumer staples sector was the worst performing in the S&P 500 this week, down 0.6%. Kroger said it settled a lawsuit filed by C&S Wholesale Grocers in Delaware's Superior Court. C&S claimed in the lawsuit that it was owed a $125 million termination fee related to Kroger's failed $25 billion acquisition of Albertsons, under which C&S would acquire nearly 600 stores, according to media reports. Shares of Kroger dropped 5.9% this week due to that drag. Next week's earnings calendar features Palo Alto Networks, which we'll be watching closely, Home Depot, TJX Companies, Lowe's, Walmart, and Intuit. Economic data due this week includes July's building permits and housing starts, as well as existing home sales and minutes of the FOMC's July 29th through 30th meeting. The week will also see the beginning of the Fed's Jackson Hole Symposium, a congregation of global central bankers, which will be watched even more closely as the Federal Reserve Chair Jerome Powell could use the podium to signal the restart of monetary policy easing in September, along with trying to catch some German brown trout in some of those streams out there. All right, so I did want to touch on the 10-year Treasury note trading at 4.33%. That is down from the 4.5% 1 month ago and down from 3 months ago, 4.45. But yet a year ago, the 10-year was trading at 3.92%. So we're up from that. Thank you, Y Charts, for that economic data and some information as we look through the reports and highlights of last week heading into this week. And now for our tax tip of the week. I've talked about this before on previous podcasts, but it's about learning about ABLE accounts. That's ABLE. People with disabilities can use an Achieving a Better Life Experience ABLE account to help pay qualified disability-related expenses. Here are some things to know about ABLE accounts. This tax advantage savings account doesn't affect their eligibility for government assistance programs. ABLE account designated beneficiaries may be eligible to claim the saver's credit for a percentage of their contributions. Eligible beneficiaries must be 18 years old at the close of the taxable year, not dependent or full-time students, and meet the income requirements. Families may roll over funds from a 529 plan to another family member's ABLE account. And disability-related expenses, including housing, education, transportation, health, prevention and wellness, employment training and support, assistive technology, and personal support services. This information is not a substitute for individualized tax advice. Please discuss your specific tax issues with a qualified tax professional. And this tip was adapted from irs.gov. All right, stay tuned for the next segment. We've got a good show for you. Hello, everybody. This is Brent Foster, and I just want to point out that the bull market continues. In our technical analysis spotlight, we are not seeing much of a change in the trend here for this bull market since the early April lows. I work off of stock charts as well as think pipes, as well as a whole bunch of other software programs and data analytics and stuff like that, like Y Charts and the rest. I just love this stuff. So the SP 500 index looks like trading today. This is the 18th of August. We're at 6,444.81. We've been in a really big move from the April lows where we were trading below 5,000. We were in the 4,750 to 4,800 range. And now we're well above that. In 2023, we were touching the 3,500 levels in the SP 500. Prior to that, in 2020, we were all the way down below 2,250 for an intraday low on the S&P 500 on the candlesticks. I'm looking at a monthly chart, actually. And what's typical is I look at RSI, I look at the S&P 500 price, volume, over time, going all the way back. This particular monthly chart goes all the way back to 2005 to 2025 plus. So it's just over 20 years. And man, we have seen a massive run, a long-term bull market from a super cycle perspective from the bottom of 2009 all the way till now, where we were at 666 on the S&P 500 intraday. Back in March of 2009. Now we're at 6,444.81. And so over the last, 15, 20 years, we've had a nice move. Now, it's not a straight line. Market goes up, it goes down. We can have these really crazy VIX spikes, sell-offs 20%. 2020, we had a 35% correction in 16 trading days. That was due to the COVID pandemic. From the bottom of that and this thing called quantitative easing, and the stimulus that the government put into play, we rallied out of that. And it was only in 2022 did we have a high inflation from the overindulgence in fiscal and monetary policy stimulus, for lack of a better term. And then we had inflation that was in 2022 and a scare there and really had a big pullback. So we rallied all the way up to the 4750 marker and then traded back down to the 3500 level. And then from the 3500 level all the way up to Trump getting elected and then going on the tariff rampage, which then caused a spike down where we lost quite a bit, but then made it back very fast at a record clip. So 25%, I think, from the bottom of there in a very, very fast period of time. So we have fits and starts along the way. But if you look at investing, these high VIX spikes, massive sell-offs, you should be getting greedy when others are fearful and then fearful when others are greedy. So given that we're at all-time highs once again across the board, S&P, NASDAQ, and things like that, now is a good time to be looking at your asset allocation, making sure you're allocated in the right way, managing risk appropriately. Not a bad time to take some chips off the table, but also at the same time, the trend is your friend, and don't fight the Fed. And all these cliches on Wall Street, those two actually are true. So if the Fed's going to lower rates, the market's kind of sniffing that out. And the trend is definitely bullish. You got earnings coming in good. You got the economy in good shape, the consumer in pretty good shape. And so it's not out of the ordinary to be at this level right now where the markets have rebounded and when Trump walked back those tariffs against other nations and started reshoring and onshoring, all this type of stuff. So, and then you've got AI, which is a key driver to the future efficiency and economic boom that is likely to come from that, hopefully. So we're paying attention to it all, but technicals are looking good. Not crazy on valuations, despite what bears might say. So I think we just keep cranking this out. Inflation slowed more than expected in July, offering a potential signal that pricing pressures may be easing, at least for now. Consumer prices rose 2.7% year over year, roughly in line with June's data. Core inflation, which strips out food and energy, ticked slightly higher to 3.1%. Eggs saw one of the steepest monthly price drops, while housing costs continued their upward trend. Despite concerns that tariffs might push prices higher, their effect appears more limited in the short term, with economic growth slowing and labor market momentum softening. Attention now turns to what the Federal Reserve might do in its upcoming September meeting. You can read more about that by checking out the show notes on our ABC News article, August 12th by Matt Zahn. Prices climbed less than expected in July despite Trump's tariffs. You'll see that out there. So on the show notes, so you'll see that. Check it out. And relocating in retirement. A lot of people tend to do that. They tend to find places to move. There's more to think about than sunny weather and home prices. Where you live can affect health and access to healthcare, social connection, and day-to-day lifestyle. Key factors that often get overlooked before making a move. Consider, does the location match the pace of life you're looking for? Are nearby medical services available and reliable? Will you feel connected to your community? Relocation can be exciting, but it's worth considering how a new zip code may shape your future and quality of life. So you can check that article out on the AP. Leanne Attali, August 9th, 2025. So do you plan on leaving an IRA to your kids? Starting this year, the IRS will begin enforcing new required minimum distribution, RMD, rules for inherited IRAs. So pay attention to that. Missing a withdrawal could result in a tax penalty. Here's what you need to know. The stretch IRA is mostly gone. Most non-spouse beneficiaries must now fully deplete an account within 10 years. Did you hear that? Deplete the account within 10 years. Annual RMDs may be required depending on when the original owner died. If they died before RMDs were required, no annual RMDs, just empty the account by year 10. If they died after the RMDs began, annual withdrawals are required in the first 1 through 9 years. So the first 9 years. Who's exempt from the 10-year rule? This is important. You're exempt if you fall into this. Spouses, okay? Spouses are exempt. Minor children are exempt, so your kids. Beneficiaries with disabilities or chronic illnesses are exempt. And heirs less than 10 years younger than the original owner are exempt. Why it matters, taxable withdrawals could bump heirs into higher tax brackets, could impact Medicare premiums or Social Security taxation, and estate strategies built around IRA stretch rules may need a rethink. Okay, so whether you're inheriting an IRA or preparing to leave one, now's the time to revisit your strategy. Once you reach the age of 73, you must begin taking RMDs from a traditional IRA in most circumstances. Withdrawals from traditional IRAs are taxed as ordinary income, and if taken before the age of 59 and a half, may be subject to a 10% federal income tax penalty. If you want to learn more or have questions about any of these topics I've discussed, reach out to us at Northbound Wealth Management, 317-399-1107. Will my money last? One of the biggest questions we hear is, will my money last? The answer, it depends on a lot more than just your portfolio size. All of these can impact whether your money will, quote unquote, last. So pay attention. Withdrawal strategy, timing, Social Security, tax efficiency of your withdrawals, sequence of returns risk, and adjusting for inflation. It's not just what you've saved, it's how you draw from it. Okay? A properly structured income strategy might add years of sustainability to your financial management. While we can provide insight on the tax efficiency of your withdrawals, your tax, legal, and accounting professionals can provide more specific details and be good teammates with working with financial professionals. The good news, before you take your first withdrawal, there are ways to stress test your income strategy under various scenarios to help you better understand potential outcomes. What are you excited to do more of in retirement? Having a financial plan is the start to that. Making sure you work out some of those models and details like budgeting and expenses and portfolio size and distributions and taxation, inflation, all the rest of that type of stuff. Very important for the success of your financial future. If you have any questions, reach out to us at 317-399-1107.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.